How business owners get money out of their business and pay less tax, part one. So business owners can pay themselves either a dividend or a distribution, depending if they own their business through a company or a trust. It's quite similar, a dividend and a distribution. The only difference with a company is that they generally pay tax at the company tax rate before the dividend is distributed to them. Once this dividend or distribution is received by yourself, this is included in your personal tax return and assessed at your marginal tax rates. So how that looks like from a numbers point of view, in this example, we are getting 100K out of your business. And in the company's example, you'll first pay tax at the tax rate. And here in this example, it's at the highest tax rate of 30%. And therefore, your dividend that you can pay yourself is 70K. And assuming you pay that to yourself and assuming the highest marginal tax rates, you will effectively have cash in your pocket of 67K. So just note that that tax amount includes the franking tax offset as well. So comparing that to a trust, there is no tax at the entity level. So that whole 100K gets distributed to yourself and then assessed at your marginal tax rates. And therefore you pay tax at 47% in this example, and your after-tax proceeds is 53K. So again, this is a very high-level example, but you can see how ultimately the same amount of money can enter your pocket at a different amount. So this is when tax planning, entity structuring becomes really important in order for you to, minimize the tax that you have to pay legally. So with some other considerations in either paying yourself through a company or a trust is that firstly, a company can retain its profits into future years. So it has that ability to defer when the cash hits your pocket and when you ultimately get taxed. Whilst with a trust, you have to distribute all that income, that profit generated within that year. So there's no discretion or control over the timing of when you get actually taxed. But one other benefit of going through a trust instead is that when you distribute this money to yourself, it can actually go to multiple beneficiaries. For example, if it's a family trust, it can go to your spouse, your children, so on and so forth, compared to a company where it has to go to the defined shareholders. So that can also allow you to distribute where the tax is ultimately paid and how much tax is ultimately paid at the end of the day. So there again,
and also just up there, Dave, with companies, there is no requirement to distribute dividends. There's nothing that's set in stone. So you can actually accumulate profits in a company indefinitely until the directors choose to distribute the dividends out.
Mm-hmm. That's right. So yeah, it has that ability. You have that timing control when it comes to a company. Yeah. So this is when considering what entity to operate out of, if you want to effectively control different entities, this will ultimately allow you to have more levers to pull and ultimately determine how much cash actually sits in your pocket at the end of the day. And then that's it. So stay tuned for part 2.